We've talked a lot about the appropriate discount rate or the risk-adjusted discount rate we should use for our evaluation of capital projects. And our starting point is, well, we should use the firm's cost of capital, their weighted average cost of capital. And it's a weighted average because we've got different sources of capital, and the three we'll consider will be common stock, preferred stock, and debt, bond financing. So here we're going to look at that cost of capital and some of the issues involved in calculating that, or I should say properly estimating that. So our weighted average cost of capital is our overall opportunity cost, weighted average for debt, preferred equity, and common equity. And the project should be undertaken only if the return on invested capital, our IRR, at least that's one measure, is greater than the opportunity cost. That's our cost of capital. So, a little notation here. We use K for cost. Not sure why. Probably the original finance article that dealt with this used K. It's the required return. Well, we've got the required return on debt. And remember that we have after-tax incremental cash flows. So we want to use an after-tax cost of capital. Now, we assume that debt, the interest on debt, is tax deductible. So that means our actual after-tax cost of debt financing is less. We need to multiply that times 1 minus our marginal tax rate. And for preferred stock dividends and common stock dividends and the growth in the value of common stock, none of that's tax deductible, so there's no tax adjustment. Our pre-tax and after-tax cost of preferred and cost of common equity are the same. Weighted average cost of capital, we've got our formula here, so we've got our after-tax costs of debt, preferred and common stock. So what are our weights? Well, our weights are the proportion of the total funding of our firm in each of these three categories. So as an example, we've got a firm. Its target capital structure is 10% preferred stock, 45% debt, and 45% common equity. So, calculate our weighted average cost of capital. Well, it's just plug and chug here, and we get 8.1%. And so we've got to discuss these weights in a little more detail. The target capital structure, remember, these are based on market values. These are not the accounting values of debt. This is not the accounting, the book value or shareholders' equity on the balance sheet. It's the market values of debt, preferred stock, and equity. So that's what we're going to use to get our proportions, our target weights. Now, there's various ways you might approach getting these target weights, or the weights we're going to use in our calculations, our estimation of the weighted average cost of capital. You can use stated target rates of the firm management, especially if they've taken steps to show that they're moving in that direction. Sometimes a firm, maybe they took on an acquisition, they took on a lot of debt to fund that acquisition. Well, often the story will be, well, we got a little more debt than we want right now, but we think this acquisition long-term is really great for us, and we've got some new cash flows from this. We're going to use that to pay down the debt. Right now our debt's 40% of our outstanding capital, and we want to get it down to 30. Okay. Well, if you believe that story and they're able to do that, then you might want to use the stated target rates of the firm management. Now, you could always use the existing capital structure weights and say, well, we just think they're going to stay the same. We could adjust this for a firm trend if we see, without any stated target or anything from management, we just see that, hey, this firm's been increasing its debt for a number of periods. Maybe we want to put our debt proportion up a little bit to account for that trend. And in other cases, you might want to use the industry average weights and figure, well, over time, they'll probably move around closely to these industry average weights. So those three ways that you might approach the problem of what weights should I use. So we've got the after-tax costs. We've got an idea of the weights. So what's the marginal cost of capital? Well, we've got the weighted average cost. So this is can be a little bit confusing because we've got the average, but when the average goes up, the marginal goes up. So the marginal cost, as we remember from economics, is the cost of an additional dollar. So if you raised some more capital, what would the cost be? See, we're talking about next year's capital budget. If we're going to take on, issue new securities, borrow more money, issue more preferred or more common stock, what is the cost on that? Not the cost on the last stock or debt that we put out. And it may be the case that a firm's marginal cost of capital increases as the firm increases the amount of capital it raises. So imagine you go to your investment bankers and you say, well, how much capital can we raise at our current interest rate? And they say, well, you could issue up to $5 million more at your 8%. But if you issue more than that this year, you're going to be paying 9%. So that component cost of capital increases at higher amounts raised. And this may also be the case with common stock. And so our marginal cost of capital curve slopes upward. It's always showing the weighted average, but individual component costs of capital are increasing at greater and greater capital budgets. So once we have that, we can start thinking about this concept of an optimal capital budget. We've got our expected returns, our internal rates of return on all our potential projects. So imagine that we order these from the highest down to the lowest. So now we've got a downward sloping curve, the investment opportunity schedule. So now we've got one curve coming up, one curve coming down. That's great in financial economics because where they cross, we can go, there's our optimal capital budget. That intersection of the investment opportunity schedule with the marginal cost of capital curve. Let's go ahead and show the actual graph here. We've got the project internal rate of return, cost of capital. We've shown it as a smooth curve here, but we'll show it a little bit as a step function, actually showing the size of the capital budget for each project. So we've got our downward sloping internal rates of return, our upward sloping marginal cost of capital. Here's our optimal capital budget right here, because for these projects here, remember they're ordered by their internal rate of return. For these projects to the left of that optimal capital budget, the internal rate of return is greater than the weighted average cost of capital. That means it's a profitable project. We should keep doing projects that satisfy that condition. But over here to the right, issuing more capital to finance these projects to the right of the optimal capital budget, the cost is greater than the expected return, than the IRR. So that means these are all negative NPV projects from here on over. So this is our optimal capital budget to maximize the expected value of the firm. So what's the role of this weighted average cost and marginal cost of capital? Well, the weighted average cost of capital is the appropriate discount for projects that have the same level of risk as the firm's existing projects. Because remember, our required rates of return on our debt, on our equity, common equity and preferred equity, depend on the riskiness of our firm. Well, specifically on the riskiness, the uncertainty about the cash flows on each of those securities. So for a project with greater than average risk, that wouldn't be the appropriate discount rate. we need to use a discount rate that we're just going to say here greater than the existing WACC if it has greater than average risk. A project, maybe an environmental project where there's really no uncertainty about the cash flows, you're going to be able to, if you do this, you can avoid these fines in the future. We might want to use a discount rate that's less than the firm's weighted average cost of capital. So, key point here, we're calculating the WACC for existing firm, its average level of risk of all its projects, all the projects that make up a firm. If we've got a project with greater risk than that, we've got to use a discount rate that's higher than the WACC. If it's less risk significantly, we should use a rate that's lower than the WACC. So, cost of debt, if the interest is not tax deductible, after-tax cost is this. So you may run into a problem. They'll say, oh, this firm's considering capital project. They live in a they're domiciled in a tax jurisdiction in which interest is not tax deductible. Or maybe there's a cap on the interest deduction. Well, in that case, we're going to use pre-tax cost for a project if it will require interest over the maximum. Because remember, our calculations are at the margin. So if it says, oh, well, you can deduct a maximum of $5 million in interest costs each year, after that, no more deduction. So if you're going to exceed that $5 million in interest costs, every dollar capital raised past that, you want to use your pre-tax cost of debt. That is no tax deduction. And same would be the case from the first dollar raised if there was no tax deduction at all, rather than a cap on maximum tax deduction for interest. Okay, here's an example of the calculation, very straightforward. We can issue new par debt at an interest rate of 7.5%. Well, this is new debt, so that's exactly what we want. We want to know the cost today. We don't care if the firm issued 6% debt a year ago. Nope, that's not relevant to decisions today. What's relevant today is what would debt cost you today. If the firm has a 40% marginal tax rate, what's their after-tax cost of debt? Well, it's 4.5%. So when it's available, use the market rate of interest. If the firm has securities outstanding, use the yield to maturity on those. Market determined, not the coupon rate, not the yield to maturity when they were issued, the current yield to maturity given the current interest rate structure. If the firm debt isn't publicly traded, we can use the debt rating and the maturity of existing debt. So maybe we go on to Bloomberg and we issue debt, and our debt is BBB. We've got BBB debt. And here's the maturity here. And we look at the yield curve, yield to maturity, in the marketplace for BBB debt. And it looks like that for some odd reason. Well, it wouldn't look like that, but okay. And so we say, well, we're going to issue 12-year debt. So we go out here to 12 years. We go up to the right here and find out, well, what's the yield in the marketplace currently on 12-year BBB debt? Debt rating and maturity approach. For firms that use floating rate debt, right? If we're issuing floating rate debt, we're paying short-term rates, and then they're reset periodically, right? Semi-annually or annually. We're going to reset to one-year LIBOR or whatever the appropriate reference rate is, or set to one-year LIBOR plus a margin. And in that case, the idea, the assumption is that, well, if you pay one-year rates over a 12-year period, the average of all of those is probably pretty close to what you would have paid had you issued 12-year fixed-rate debt. So for firms that use floating rate debt, you should estimate the cost of the firm's debt using the yield curve and the firm's debt rating. So we're right back to this. Getting the required return on preferred stock is very straightforward. It's the preferred dividend over the market price. Remember, we don't expect any appreciation, any growth in the value, because the dividends are set, typically for the life of the preferred, which may be perpetual. So for a non-callable, non-convertible preferred stock, if the dividend is $8.50 and it's selling in the market for $100 a share, what's the firm's cost of preferred stock? Well, looks like 8.5% to me. Let's be surprised. Nope, no surprises. 8.5%. So our cost of preferred is straightforward, and remember, there's no tax adjustment. Now the cost of common equity. We've got three methods of doing the cost of common equity. And the first one involves the CAPM, the capital asset pricing model, which we haven't covered in the curriculum. Certainly you've run into it if you've had finance classes in your college education, but if you haven't, well, we don't get to it until we get to portfolio. So for now, I just want to describe this, and you'll learn more about it and understand it well after we get through the end of the curriculum, our portfolio management sections. But for now, what does it say? Well, the capital asset pricing model, it was a model that's developed to price risk. And the type of risk that we end up pricing is market risk. So what we really care about is how a stock's return varies with the market, because that's the risk we can't diversify away by holding a mutual fund of 400 different stocks. So that's the short version. So what does the equation tell us? Well, it says, well, you can earn the risk-free rate even if you don't take on any risk. But if you take on some risk, and we're going to measure that risk by beta. It's a standardized covariance with the market term. And the market portfolio itself, a well-diversified portfolio of all the stocks in the market, all the equities in the market, sometimes all the investable assets, okay, is 1. And so we're measuring relative to that. Some stocks, some projects may have more market risk than others, more than the market. Some may have less. So we can have a beta between, under 1, above 1, whatever. But the beauty of this equation here is it says, well, the difference between the expected return on the market and the risk-free rate, that is our market risk premium, MRP, market risk premium. So if beta is 1, that's how much extra return we expect to get for holding a well-diversified portfolio of stocks, rather than just holding treasury bills, the risk-free asset. So let me state it. Same thing, shorter. Risk-free rate plus 1 market risk premium for every unit of beta or market risk that we take on. So, long explanation for here, but we'll get more later in portfolio, as I said. So this is one way, this is method 1 of estimating the required rate of return on common equity. And we're using the firm's beta here, the firm's beta specific to that firm. So if the T-bill rate's 5%, the expected return on the market is 11, and the firm X's beta is 1.1. Well, let's see, expected return on the market. We aren't given the market risk premium here, but we have the expected return on the market, and we have the risk-free rate, or at least our proxy for the theoretical risk-free rate, the T-bill rate, which is saying is 5%. So the difference is 6%, and we're going to get 1.16% premia. So here's our 6% market risk premium, 1.1, that's 6.6 plus 5, 11.6. So you may as well go ahead and memorize that formula for the CAPM. You're going to have to do that at some point anyway. Okay, our second method here, we're calling it the dividend discount approach. It's based on a present value model for a firm that pays a dividend that will grow at a constant rate forever. It's called our constant growth model. We'll also call it the Gordon growth model. But that model says, well, the present value of this stream of future dividends in the limit is equal to this. And so what we're really doing is taking a present value of a stream of dividends that starts with next year's expected dividend, D1, and we assume that will grow at G each year forever. And if that's the case, the limit of this infinite series is D1 over K minus G. Well, if we rearrange this, if this valuation holds, then this is a rearrangement of that. That must also be true. But there's some intuition there too, because D1 over the current price, the expected annual dividend over the current price, that's the dividend yield. That's what you're going to earn in percentage terms from dividends if you buy the stock. G, well, that's the rate of growth. That's the rate at which dividends will increase and equity increases and earnings increase. So it's also the rate of increase of the stock price. So this is really capital appreciation. And this is the dividend yield, and those are the only two ways to make money investing in common stocks, from the dividend yield if it has one, and the growth in the value of the shares. So that's the intuition of this dividend discount approach. I think I've described these. D1's next year's dividends, P0's today's stock price, and the expected constant growth rate. And how do we estimate that? Well, that's the ROE times the retention rate. Remember, our retention rate is 1 minus the payout rate. So the payout rate is the percentage of earnings that we're paying out as dividends. So if that ROE is 10% and we pay out 30% of our earnings as dividends, that means we can reinvest. 70% of that will be retained earnings, which goes to increase equity. So if we assume a constant ROE, we end up with a constant growth rate of equity, constant growth rate of earnings. So let's take a look at an example. We've got a stock price today of 21. Next year's expected dividend, that's our D1, is $1. Our constant assumed ROE, return on equity, is 12%, and the dividend payout ratio is 40. So in that case, first, figure out our constant growth rate. Well, we have a return on equity of 12%. We're paying out 40% of that, which would be 4.8%. That leaves us with 7.2% to reinvest in the company for growth. Given that growth rate, we just take our D1 over P0 plus G, and there is our estimate of our required return on common equity. Now there's a third way to do it. It's my favorite way. It's dead simple. We look at what the firm pays as a yield on its bonds in the market, and we say, well, equity is more risky than bonds. We better add something. And so we choose a risk premium to add to that. And under this method, it's often between 3 and 5%, so we chose 4% in our example. So this seems kind of naive, and it's certainly not as fancy as the capital asset pricing model or the constant growth model. But it's hard to do something really stupid with this one, even if the numbers are odd for some reason or another, because we're just adding something to the bond yield. It's based on judgment. It's imprecise compared to the others. Now, you're thinking, which one should I use? Well, if you're asked to calculate one of these, you can tell by what's given to you in the problem. If you're given the bond yield and some arbitrary equity risk premium for the firm above its bond rate, you'd be using this one. If the question mentions a stock's beta, the expected return on the market, the risk-free rate, clearly we're talking about method 1, capital asset pricing model. And in method 2, if you're getting information about ROE, payout or retention rates, dividends, dividend yield, we're talking about method 2.